JP Morgan says it's time to take your profits and sell your tech. They believe outperformance is not going to happen moving forward. Market Insider says investors should rotate away from tech into these other four sectors of the market before we enter into 2021. And finally, Goldman Sachs says it's time to buy value stocks and sell some tech. So with these major headlines coming out from some of the top investment firms across the globe, all saying that it's time to sell out of tech, lock in some profits while you're still up, and rotate into other sectors of the market. So is now the time to sell your tech stocks? Over the past few months, tech stocks have actually been on the decline. So is it time to sell although the overall tech sector is down at least 12%? In this video today, I'm going to share my thoughts on these headlines, discuss if I'm going to be selling my tech stocks, and go over what I'm going to be doing with my financial freedom portfolio, which has a large majority of it within the tech sector. So I'm going to share with you my personal opinion on this situation and what I think about these major headlines from these top brands all saying that it might be time to reduce tech in your portfolios. So if you're new here, I am the Gen Z investor, and every single day we talk about the stock market, we go over different stocks you can buy and sell within your portfolio, so please hit that like button and subscribe. So we're going to jump into my personal financial freedom portfolio. I currently have a value of over $65,000, and this is up only around 3%. Over the past few weeks, we've seen a lot of volatility in the market, and the overall tech sector has been hit pretty hard. If we take a look at the tech sector, this is shown by Vanguard's Information Technology ETF. From its last peak in the month of September, the tech sector is down close to 12%. So the largest holdings in my personal portfolio are made up of some of the largest tech firms on the market. We have companies like Apple, Microsoft, Visa, and MasterCard making up some of the largest holdings in my portfolio. And if we take a look at my sector diversification, 35% of my portfolio is made up of tech stocks. So over a third of my wealth, a third of my financial freedom portfolio that I expect to grow over the next 10 to 20 years is made up of the tech sector. So I should be worried when I see headlines saying time to sell tech, reduce your tech position, buy value stocks. But for me personally, I'm not scared. And we're going to go through the reasons why I'm not scared throughout this video. So my portfolio and the largest holdings are made up of two of the largest companies on the globe, Apple and Microsoft. I have around $10,000 worth of Apple stock and around $7,000 to $8,000 right here worth of Microsoft stock. These companies, I believe, are going to be larger in 5 years compared to where they are today. And that is why these headlines do not scare me. Investors who are investing for a shorter period of time, who are focused on the current price of these companies, then now, yes, may be time to take your profits. But for me, a long-term investor who's focused on growing wealth consistently for over decades, I'm not worried about short-term volatility. I like putting my hard-earned money into companies that I believe are going to grow, that have a nice point of difference, have strong moats, have strong brand loyalty, and that I believe are going to continue to be around over the next decade. And I believe names such as Apple, Microsoft, Google, Facebook, the largest tech companies in the world, I don't believe they're going anywhere. I don't care that they're up 100% over the past year. Apple stock is up 79%. If we take a look at Google stock, they are up over 28%. If we take a look at Microsoft, up over 40% on the 12-month chart. So a lot of these companies have seen very nice gains over the past year, but I don't believe it's time to sell. When you sell stock, for me personally, is when I see a better opportunity on the market. I sell out of a core asset of my portfolio when I believe that money can be put to use into an asset that's going to outperform the company that I'm selling. Right now in the market, we're seeing a lot of younger tech firms that don't have a lot of revenue, that are being traded at crazy high PE ratios right now, that I don't believe I need to sell out of my Apple or my Microsoft position. Regardless of how high they climbed, I believe over the next 5 years, Microsoft and Apple, for me personally, are going to be a larger company than where they are today. So that's why we're going to go through each of the top 4 tech stocks and determine if it even makes sense to sell them. In the world we're living in today, companies are being traded at crazy high PEs. We're seeing PE ratios of 100, 200, even 300 plus for some of these high growth tech stocks. When you take a look at the strong household names that people use on a daily basis, like a Microsoft, they're being traded at a forward PE of 30. So which is considered high compared to the average of the overall market, but is nowhere near some of the higher growth companies that we've seen on a massive run-up. So although there are some tech names on the market that are up maybe 1 to 200 to 300% this year, that may not have the financials and the balance sheet to, worthy that kind of market cap in that run up, that okay, maybe for those companies, it may be time to sell. But for the large top 4 that we're going to focus on today, such as Apple, Google, Microsoft, and Facebook, these tech names, although they've seen a run up, I don't believe are slowing down anytime soon. We've seen these companies over the past week report earnings, and they absolutely crushed it. All 4 of the largest tech companies on the market destroyed their earnings expectations. They beat on both revenue and earnings per share, and they all beat by a significant amount over analyst expectations. So I don't believe now is the time to sell. I don't plan on reducing my portfolio in any way, and I believe now, when we've seen the market actually decline, may be a nice time to buy. For example, if we take a look at Apple stock, on the 1-month chart, shares are down over 12.5% from their nearest high earlier in the month of October. So if I'm an Apple shareholder and 3 weeks ago shares were trading for 12 to 13% higher, why would I sell now? Apple reported a strong quarter. They have the new iPhone 12 coming out over this next few months, and I believe Q4 is going to be even stronger for the company. So if I see some nice outlook moving forward over the next few years, why would I be worried about some short-term volatility when the core company is still growing at a nice rate? So that's just my perspective on the situation regarding these companies and the fact that you may not need to sell them regardless of what these headlines that are kind of scaring young investors are telling you to do. Of course, if you believe there's other assets that might have better use for your money, then by all means, lock in your profits. It's never a bad idea to lock in profit. But of course, if there's nothing else that's going to work harder with your money, then it may be worth to just stay in and hold and not sell off like these top firms are telling you to do. Also, you have to take into consideration, if you were to sell off, what is that money going to do? Are you going to wait around for a dip? Are you going to increase your cash position? Which is not a bad thing in some certain situations. But for me, I'm comfortable just adding and contributing money from my, my paycheck every 2 weeks into my portfolio and bolstering up my cash position that way. Collecting the dividend payments, letting them sit in cash, waiting for a dip. I don't feel the need to sell out of positions to generate cash and let it sit there at this current moment in time. So we're going to go through each of the top 4 tech firms. We're going to go over their income statement and their balance sheet. These companies are some of the strongest financials out of any sector across the globe. So when you buy a company, you always want to make sure they have strong fundamentals. That is like the easiest and first rule you learn when picking individual stocks. Strong fundamentals, strong revenue growth, strong earnings, very solid balance sheet. Those are the key things you kind of look for right at the beginning when you start investing. And all 4 of these tech firms have all of those. So I really don't understand why these large firms are choosing to sell and where they actually see the value on the market right now. So right now we're going to go into each of the top 4 tech firms, take a look at their income statement and their balance sheet to determine if any of them look like they could be worth a sell right now, or if we believe their trends upward are going to continue to move forward over the next 3 to 5 plus years. We're going to start with Apple stock, currently trading at $108 a share. The company is up 79% this year and trades at a forward PE of 27.8. Market cap of 1.85 trillion, and you can see on the 52-week range, trading closer than the middle, a pullback away from the 52-week high, which was set around $137 a share. We notice that on the past month, they are down over 12%. And why is the time now, after they reported a great quarter, to sell Apple stock? If we take a look at their income statement, this company brings in a ton of revenue every year. Over the past 12 months, $274 billion of total revenue. And if we take a look at their net income numbers, $57 billion worth of net income. Absolutely massive net income produced from Apple. High profit margins, great net income numbers. I don't believe this is a company that generates $57 billion of net income that has been growing year over year is really worth a sell right now. Especially if we take a look at the balance sheet, they have total cash and short-term investments of over $90 billion and over $143 billion of total current assets. Compare that to their total current liabilities of only $100 billion, a very strong ratio, around a 1.4 for the current ratio. And overall, with so much cash and investments on the balance sheet, this is a brand that is going to survive for a very long period of time and has no issues with regard to liquidity over the short term. If we move on to the second biggest company, we're going to take a look at Google. This tech brand has been on fire, and this is a company people use every single day of their lives. People use their Apple products and search things up on the internet through Google. So these are some of the largest tech brands at work are intertwined with each other. And Google is up over 28% this year. They posted the strongest earnings out of the top 4 tech firms, absolutely smashing analyst expectations. Huge growth on both revenue and earnings per share for Google over this past 4 quarters. And some of the top analysts right now, for example, Jim Cramer from CNBC, he was asked if he could only hold one of the major tech companies, who would he hold? And he answered Alphabet, Google's parent company. That's the one he chose. He had the option of any tech company on the market, and he chose Alphabet. So I don't believe now is the time to sell Google. I don't believe they're going anywhere anytime soon. If we take a look, they've had beautiful revenue growth. Exponential revenue growth year over year at a very fast rate, with over 171 billion of total revenue in the past 12 months and over 35 billion of net income in the past 12 months as well. So another company with very high profit margins, extreme amounts of net income coming in year over year to help the company grow. And Google has one of the best balance sheets on the market. They have total cash and short-term investments of over $132 billion. There's not that many companies on the actual stock market worth $132 billion. And Google has that much sitting in cash on the balance sheet. This allows them to acquire almost any business they want. They can have research and development costs that can pay for everything. Google does not pay out a dividend. They have very little debt on the balance sheet, and they can really do anything they want. They have so much cash, it will allow them to expand into any different market across the globe, and allows them to do so much with the business. If we take a look, total current assets of $164 billion compared to total current liabilities of only $48 billion. And one thing I'd like to point out with Google, they have $86 billion of total liabilities on the balance sheet. So all the debt for this entire company comes in at $86 billion. They have over $132 billion of cash. So they can pay off every single dollar of debt on the balance sheet and still have over $50 billion sitting in cash. That is remarkable. That is almost unheard of to see. This balance sheet, I can almost believe, can't get any better. In the low interest rate environment we're in right now, debt is super cheap, that it actually makes sense for Google to just have this very cheap debt on the balance sheet and not pay it off right now. It's not worth it for them to use the cash to pay it off when they can actually use the cash to generate higher amounts of income moving forward. So this company, with one of the best balance sheets I've ever seen, is it really worth a sell? They're not going anywhere. Google's only going to expand. They've proven to grow during good times and bad times, during a pandemic, posting one of the record-breaking quarters they've ever seen, and with a balance sheet that's the strongest ever. Why would we sell out of this company? Nothing is negative. Nothing is fundamentally wrong with Google right now to sell. Just because we've seen a run-up in the share price of 28% this year, to me, that doesn't warrant a sell of a great core asset. The third tech firm, my personal holding as well, Microsoft. Up 40% this year. They have seen a pullback, currently at $202 a share, compared to a 52-week high of $232. So a significant pullback away from the 52-week high, and over a shorter-term perspective, another dip in the market. Of course, the overall market has been down, but they are down over 12.6% as well. So I own this core asset. My returns have kind of been diminished by over 12% as of late. Am I going to sell when I see my returns drop 12%? No, the whole idea of the stock market, the typical saying is buy low, sell high. Don't sell when things are low. Why sell when a company has just witnessed a short-term dip? And like I mentioned earlier, I have nothing else to transition my core assets into. This company, total revenue of $147 billion, continuously growing year over year as well, with beautiful net income numbers of over $47 billion of net income. $47 billion of net income on $147 billion of revenue. Extremely high profit margins. Again, companies with these high profit margins, with these high revenue numbers, these are the brands that are not going anywhere. Companies who don't really succeed over the long term in business are the companies who don't make money. I know people say cash is king, cash is not king. That there's a huge debate about that. But in business, fundamentally, cash is king only because you need cash to survive. You need money to come into a business, to grow the business, to pay employees, to keep the lights on. So in the little bit of easy terms, cash is king, and this company produces a ton of it. If we take a look at their balance sheet, they have total cash of $137 billion. So similar to Google, an insanely high cash pile that is worth more than most companies in the world. Total current assets of $177 billion. Meanwhile, they have total current liabilities of 77 billion and overall liabilities on the company of 177 billion. So another rock solid balance sheet. Current ratio well above 1. Total current ratio sits above 2 actually right now. So this is a company where over the shorter term, we have absolutely no issues, no worries, no stress. They're going to be fundamentally sound and will continue to grow for a longer period of time. And we're going to wrap it up with Facebook, the final of the big 4 tech firms, ticker FB at $260 a share. $749 billion market cap on this company. If we take a look at their income statement, beautiful revenue growth, absolute insane exponential growth for this company. 5 years ago, around 18 billion of revenue, up to almost 79 billion in the past 12 months. So huge growth in revenue year over year. And you can tell by this chart, the revenue is trending upwards at a very fast rate. Another company with very high profit margins, 77 billion of revenue, and 25 billion of net income. Profit margin of around 30+%, absolutely incredible. And if we take a look at their balance sheet, 55 billion of total cash and investments. If we take a look at their total current assets, around 65 billion, and another company with an overall ratio very strong, where we won't have to worry about anything over a shorter term or longer term as well. So we'll take this into perspective. Around $12 billion if we round of total current liabilities. They have total current assets of over 65 billion. That is a current ratio that sits above 5. They have 65 plus billion of total current assets with only 12 billion of total current liabilities. And if we take a look, they have 28 billion of total liabilities. All the debt on the balance sheet totals up to 28 billion compared to their total assets of around 146 billion. So absolutely insane numbers. Again, a company with a rock solid balance sheet. I'm a balance sheet lover. If I look at stocks, I like companies with strong balance sheets. It's who I am, it's the fundamentals of business, and the balance sheet tells a picture of the health of a company. And all these companies are extremely healthy. These are the LeBron James, the Michael Jordans, the Cristiano Ronaldos, Lionel Messi, like the top athletes in the world who outperform everyone, the Tiger Woods. That's who these balance sheets are. These companies are so strong, I don't believe they're going anywhere anytime soon. And in my personal opinion, I will not be selling any tech stocks. Regardless of these headlines, more and more can come out. I can see them every single day about how we should reduce tech. But for me personally, I will not be doing that. I think they're too strong. Fundamentals are still there. We're still have strong earnings, strong expectations moving forward. And I feel no need to lock in some capital gains right now just to hope to see a dip moving forward, because the market's so unpredictable. The way we are living in this right now, there's volatility in this market. None of us would have expected that after all these tech companies to beat earnings, that we see a pullback of over 5% in all the major names. That was completely unpredictable. When we saw these earnings results, the overall consensus was over the next day we would see some green, but that didn't happen. So for me to sell out of some core assets with the hope that I can buy into the same companies later is not what I do. I am okay with my portfolio sitting around 35% tech. I will continue to hold, continue to buy more of these companies if they continue to dip, and bolster up my portfolio for the long-term growth. So that was my opinion on these headlines. Not worried about them, not really too concerned right now. So I appreciate you tuning in, and I will see you in tomorrow's video.